Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Too bad. We don't have a massive week for economic reports, but we do have still a heavy week for earnings. That will taper off a little bit later in February, but still it's still a busy week for earnings. So make sure you guys check all that. But let's quickly review kind of what's been happening up to this point. And I really recommend that you do this review on a Friday or over the weekend to say, how did we end up? What was all the contributing factors? What's the engines driving things? So in a nutshell, we had, and you've repeated this before, but in a nutshell, we had heavy tax loss selling in December. 30-day wash sale rule puts that into January. They were rebuying those same issues that were the most sold. We had some amazing performances. Now, remember, when something goes down 100% in 1 year, right, it takes 200% to get back to where it was, or it goes down 50%, it takes 100% to get back to where it was. So some of these numbers, when you see the performances, sound amazing, but they're still way below their highs. But we still have to look at, how much the market moved, how much these stocks moved in a very short period of time, and say, does it have the ability to continue, or is it going to take a pause? And sometimes in February we get that pause, and it's happened, in other years where January was reasonable and in February was softer. Looking at how Friday went, our seasonality said the first Friday of February was supposed to be softer, and it did open down. Now, on an open to close basis, some of the markets were up, open to close, but close to close, they were down. So that kind of went as it was expected. But we had this backdrop of, kind of FOMO, fear of missing out, getting back into tech, cyclical stocks. Some of the stocks on Friday that were up were, retail, stores, stuff like that, apparel. We've seen big moves in semiconductors recently too, and then the financials on Friday did pretty good. And then we have these weird things like, Apple being up 2.44% on Friday and Microsoft being down 2.36%, right? Tesla being up 0.91%, and banks being up, JP Morgan, Wells Fargo, American Express was up 3.31%. We had some oil stocks up, a lot of them down. So ConocoPhillips obviously has other issues with some of its properties, but down 2.87%, where Exxon was up 0.69%. So a very, very mixed bag. If we go into the groups from Friday, we had energy down slightly, financials only down slightly. Again, the tail of some of those financials really, really strong, but as a sector overall, just down slightly, but less than the market on a close-to-close basis, of course. Healthcare down slightly. And then consumer cyclical was down significantly, 2.67. Yet there was these stocks that opened down huge and rallied back, So we had an S&P list. Well, actually, all the lists had a bit of pressure on them on Friday, but our NASDAQ and S&P list didn't do very well. I don't think there was that much wrong with the list itself. I think what the problem, if you wanted to execute, was you would be shorting a lot of the discretionary and technology and things into a deep discount. So let's say the market's opening down 1%. The Qs were opening down even more than that. But I think the SPY was opening down, if I can remember, 1.39% or something. So if your stocks are opening down more than that and you're shorting them, then there is the risk that they slingshot back, that they try to fill the gap. Because if there's only, like, in order for things to balance out, the SPYs would have to decline more, catch up to the stocks. But the stocks have generally higher betas, so that may not catch up at all in that sense if the market continues to slide. But if the slingshot back, those higher volatilities, those higher betas are going to work against you, and that's kind of what happened on Friday. The list for our shorts, much of it was sort of okay from a close-to-close perspective, but because it opened down so much on the overnight gap, that those things ripped up. Whereas our longs ended up not by being discretionary picked, but by the day before and how things kind of closed. The stocks for that day were more defensive on the long side. Well, guess what? They opened up. Amgen opened up huge on a down day. Kimberly-Clark opened up. Lilly opened up, and so on. And so many of our longs opened up on a big down open in the market. Well, right there, there's a problem. Because you just paid premium over yesterday's close. And what are people going to do? They're going to go, well, hey, if the market starts coming back, I'm going to rotate. I'm going to get out of defensive and put it into discretionary. I'm going to put it in a tech. And so many of these, risk on assets actually ripped up. So this was kind of one of those reversals that, because of the employment report, which knocked the market down, it was already trading down, probably because of a little bit of expectancy, leak of information, seasonality it was already trading down. And then the employment report knocked it down further. And we had one of those events where it rallied back to fill the gap. And we know that the high probability of gaps being filled. So we had that expectation realized. Well, with that gap fill, many of the stocks that opened down way more than the market rallied back to try to fill their own personal gaps. And that, from open to close, put pressure on our shorts, whereas our longs, all they had to do was stay the same or pull back a little bit from their premium open, and you can see the problem. On an open to close basis, you are not going to end well. So structurally, there wasn't much wrong with the list. Execution-wise, there's a problem, because if you did it all at market orders, you got what you got. You sold into the hole and you bought above the previous close for the stocks on most of the defensive ones. And then open to close, that worked against you, as it was one of those gap fill days. So what could you do differently? You could, have also, I always recommend having one list that you generate for risk on, one list that you generate for risk off, and a neutral, sort of very diversified quantitative type list. That could be for the inside days, the non-events. You don't have a big engine driving things. So on the risk on day, right, you can have a down open, and you want to deploy your risk on stuff because you get everything on sale. Everything's at a great discount. On a big up day, maybe you want to deploy the risk off because things are opening at such a premium that if you're selling some of those stocks that people just have to own and pay way too much at the open, you're going to get a beautiful mean reversion from that. So just think about these different approaches. The second thing is making sure that you choose the price of your participation by using limit orders. Had that been done on Friday, it didn't necessarily make the list positive, but it was almost break even. right? So no damage done, let's say, because you only got filled on about a quarter of your positions. And you know what? I would rather have a day where nothing is, we didn't get what we wanted. We didn't get all 20 stocks on. We only got 5 of them, and maybe hedge with the SPY or whatever. I'd rather have that and have like non-performance than I would lose a lot of money. So it's why the execution is so critical on how you do this stuff. All right. And moving on here into where do things sit now after that week that we had where, January, a lot of risk on, a lot of FOMO, a lot of, trying to rebuy these things that got beat up last year. We saw some great performances. The market was also been very, very hopeful that the Fed is going to start to go easy on us. And in fact, Powell's talk on Wednesday was a little bit more accommodative, a little bit more dovish. But then the employment report on Friday changed the perspective, especially from the bond traders, because the bonds sold off, which meant rates are rising. And we have probability now of 61.8% for a May rate hike. And it went up from 30%. So on Thursday, it was only 30% chance of a rate hike in May. Now we've gone to 61.8. And that's in addition to the one that's already fully priced in for March. So, the economic report signaling something different than we heard on Wednesday. But now you could say, Powell didn't actually say he's going to go easy. It's just the market has been interpreting the longer he talks, the more accommodative or a dovish he actually is. That's the interpretation that the market's taking away from it. So we could have an interesting lull week here next week. Could be a lull week. And after the big rally we've had, it would be right to be defensive, and make sure that we're not exposed too much after this. And of course, we could be still wrong. I mean, the market may want to continue to buy everything. That's its prerogative. But anyway, I'm going to circle over to Dave here, and we'll come back and look at where the markets are before we end here. But Dave, what are the economic reports and some of the highlighted earnings for this week?
Yeah, in terms of economic reports, it's a little bit light this week. On Tuesday, Federal Chair Jerome Powell speaking at the Economic Club of Washington. So anytime he speaks, that could move the markets. And then throughout the rest of the week, there is some Fed speak here and there. Wholesale inventories on Wednesday, initial jobless claims on Thursday, consumer sentiment on Friday. So not as heavy as it was last week, but there is some banter there. And then there are tons of earnings still. So Monday, Tuesday, we have just many symbols each day. On Tuesday, we have Chipotle. On Wednesday, we have Disney. And Friday, we have PayPal. So those are some of the noteworthy ones. But then throughout the week, there's just tons of regular Royal Caribbean and VF Corp. And you name it, there's a whole bunch of earnings. So whatever you are trading, you have to cross-check every day in terms of earnings. And in terms of seasonality, we're not in a window right now for anything in terms of the almanac. Mid-month seasonality will be far off next week, and we've just come off that first week. So it is kind of a lull week, and February's do have kind of a burst in the middle of the month, but softness in the beginning and towards the end.
Okay. So moving over to the US dollar, we did have 2 big rally days, Thursday and Friday. Okay, so the dollar moved up. the same thing with bonds moving down. And so the US dollar was up, the euro was down, Japanese yen was down. Some of the commodity-based countries like Australia and Canada were down. New Zealand was down as well in terms of their currency. The bonds, again, were down, signaling rates are adjusting again to more upside. So this impacted our metals. So gold had 2 strong days down. Silver, platinum, copper as well, starting to roll over. So copper at the beginning of this year was pretty. I mean, the way it moved was like we were discounting recession entirely. That there's not going to be a recession. We're just going to have a really soft landing. But in the middle of the month, it kind of turned and started to roll over again. So maybe that recession argument is back on the table a little bit, even though Powell signaled that they should be able to handle this tackling inflation and not bring about a significant recession. So the bonds tend to disagree a little bit. US dollar tends to disagree a little bit. Copper tends to disagree a bit. So if the dollar continues to rally, then going to see more pullback on gold after its amazing rally all the way from November until just the last 2 days. So where we're at right now with the Dow Jones down 79 points or 0.23%. S&P 500 down 13.75 points or 0.33%. So again, we had that pretty big move from the end of the year, beginning of January, all the way up to just recently, Wednesday, and then or Thursday even, sorry. And then Friday, we pulled back slightly. And now we're down a little bit lower than that. NASDAQ down 48.5 points or 0.38%. And Russell down minus 8.4 or 0.42%. So of the 4 markets right now, the Russell is the weakest from the futures. Then the NASDAQ, then the S&P 500, and then the Dow Jones. So what does that signal? That signals more of a defensive risk-off sentiment. And with a lull week, that could be the case. If we go to currently where bonds are at, the 10-year is slightly down, 30-year as well, 5-year, and the 2-year all slightly down. The 10-year is actually down 0.15%. And looking at the currencies at the moment, the US dollar is up 0.18%. So all that stuff we mentioned is at the moment, now it could change by the morning, but at the moment is signaling leaning towards maybe the rally is going to take a bit of a pause. That's what I'm looking at here. Energy, where are we at with oil here? Now, there's a big difference between how the stocks are performing sometimes and how crude prices themselves, but crude is up just slightly at 0.12%. Brent crude up 0.24. So West Texas is the 0.12 and Brent is 0.24, so up double that. Yeah, and gold is up 0.69% right now. So we'll have to see how this relates to the dollar. Dollar's just up slightly. Gold's up a little bit more percentage-wise. We'll have to see. But it had 2 big down days in a row. So even if you had a bit of exposure to basic materials, including gold and silver, I don't know that you would take it on the chin because you've already had two massive discounted days. So I wouldn't worry too much about that exposure, even if the dollar, goes up a bit. I don't know that it's going to negatively impact the metals. at least for tomorrow. So hope that helps. We covered it all. Anything else?
No, that's it for now.
We had a pretty big earthquake hit Turkey, 7.8. Looks like that was earlier today here. No, lots of things going on, eh? All right. Well, we'll let you guys go. That was a pretty good, lengthy presentation here. So we'll catch you next week.
Thanks. Good luck.